Greetings to everyone. Yet another quarterly report with excellent figures, but perhaps disappointing expectations. A quarterly report that causes a crash. We're on Wall Street. We're talking about Walt Disney. In my opinion, an unmissable opportunity is coming up, and let's take a look at it together. Yet another quarterly report, one of many, we could say, on Wall Street, that is liked for what has been achieved, but not for the guidance. There are really so many Wall Street quarterly reports where the actual results are good, but the outlook for the coming quarters is more pessimistic. Think, for example, of Lululemon Athletica, and Walt Disney is no exception to this situation. Let's take a straightforward look at what happened on Thursday. On Thursday, Disney recorded a daily loss of 7.75% in its stock price. What happened? Well, in reality, we can see that earnings continue to grow steadily while the stock price remains very, very low. The stock maintains a price to earnings ratio below 20, so it absolutely does not seem to be overvalued by any standard measure. And even sales revenue is, although not sharply, still steadily increasing. What is happening? Well, what's happening is that, as we said, the results have certainly been significant. Bob Iger, the CEO, and Houston discussed the company's performance and outlook for the future. Strong earnings growth, the adjusted earnings per share, EPS, for the 2025 fiscal year increased by 19%. These figures are absolutely significant. Usually, just the EPS alone is enough to send the stock soaring when the results are released. Compound annual growth rate of 19% in adjusted earnings per share over the last 3 fiscal years. So, as you can see, there is strong earnings growth. These are definitely situations with solid positive results already achieved. The operating income from the streaming segment increased by 39% in the fourth quarter, reaching $1.3 billion, and so Hulu has become the general and global entertainment brand within Disney+. The company is working to consolidate entertainment content into a single app, and we also see ESPN. Here we are. The launch of ESPN's full direct-to-consumer service with its improved app has been successful and includes new features. The audience for live sports events remains strong, with viewership on ESPN networks up 25% compared to last year's president. And yet, we see, with a collection of data, that absolutely everything is growing. But in fact, EPS may be the most important. Let's keep reading. Record operating profit both in the fourth quarter and for the entire year, with an increase of 13% in the fourth quarter and 8% for the whole year. Various new cruise ships are underway, Disney Destiny and Disney Adventure, and expansion projects are ongoing in all the parks. And then in fiscal 2000, a new theme park is planned for Abu Dhabi. And again, I want to emphasize this because Disney's drop in response to these numbers is striking. Returns for shareholders. The board of directors has declared a cash dividend of $1.50, which is a 50% increase compared to fiscal year 2025. And then $7 billion in share buybacks, so a significant buyback, doubled the $3.5 billion in 2025. So we have a series of positive news, except, as we said, what often happens is that the macroeconomic situation, the general context, doesn't give investors much optimism with indices so high. And so just a comma, just half an announcement during an earnings conference, and everything changed. The quarterly revenue was below Wall Street estimates. Attendance at national parks was slightly lower. And here is what could be a possible outlook for the future. Double-digit growth is expected in adjusted operating profit as well as revenue growth. The goal is to increase TSI business revenue by double digits. In short, however, seeing revenue that may have increased but less than what analysts expected has created this situation of a decline in value, which in my opinion is exaggerated. The conference call on the results highlighted a year of solid financial performance, driven by the success of its film studios, streaming services, and experiences segment, although revenue slightly, just imagine if they had disappointed significantly, slightly fell short of expectation. The company recorded solid growth in operating profit and so on and so forth. Now, faced with these figures, having such a crash, in my opinion, leads us to potentially having an opportunity in the near future. The stock appears, based on the average of the four fair values from the forecaster, to be very undervalued. Here we can see the growth in revenue and profits over the years. For 2025, we see debt absolutely under control at 32% compared to equity. The ROE is good, not outstanding, but good, and the profit margin is also solid. We do see a slight decline in revenue during the year, but despite this, the situation still seems to be that of a solid company. Without a doubt, I would say Piotrowski's score is 8 out of 9. We see that the company is classified as resilient because it is actually creating value and sharing it with shareholders. The weighted financial data are increasing, and in the last year, shares have been decreasing. As we read, 7 billion in share buybacks are planned, so a buyback that will be doubled. Now, faced with this sequence of still, these are certainly positive and encouraging figures. In the past 7 years, revenue has steadily grown from 60 billion to 94 billion, and the net operating margin, which after taxes is the profit remaining, is 12 billion, which is well over 10%. Now, what we can reasonably expect at this particular moment in time is simply to witness after such a significant and notable gap, because in the end, these types of gaps are generally considered to be a negative signal, even if in some cases they can be covered or filled. However, in the very short term, I do not think that the Disney gap can be easily or quickly covered. Let's take a closer look at the market mood meter. There's an important signal here, as it has just dropped below the zero line, which is known as the trigger. So in this situation, we have a clear sell signal. The market mood meter, to summarize, provides us with this indicator which measures the speed using the Hull moving average, the Wyckoff method, and also the trended price oscillator. These tools together help us to better understand the current state and direction of the market, giving us valuable insights into potential future movements and trends. So, these three tools are visually summarized in a very convenient and easy to understand manner in the market mood meter, which is just now crossing below the important zero line and therefore suggests that a continuation to the downside in the coming sessions is more than possible. If we basically go and take a look at the Mutliful website, which by the way we access directly from the news section because we have this very handy and extremely useful tool that provides us with the latest news updates in chronological order, making it much easier to stay informed. There's this particular analyst I follow whom I really like and whose insights I find very valuable and interesting. And he tells us here's why, because I really love this company's stock for long-term investors. So he basically summarizes some of the fundamental data and important settings of the company. And in this particular case, this company is a leading conglomerate in its sector with numerous sources of growth. California is huge. It has established itself. And okay, we won't go into that now. Too much into it. To go deeper, but here is the magnificent mouse, and here it's interesting to take a closer look. The only sector I intentionally included is entertainment. That sector is no longer as intensely concentrated in Los Angeles, but the city and its surroundings still contain its core, particularly the city of Burbank, adjacent to Los Angeles, where we find the current king of the sector, Disney. We might be witnessing the arrival of a new giant. The great but struggling rival Warner Brothers is seeking interest. Warner Brothers Discovery is soliciting offers for a new owner, so we are talking about a possible, so to speak, competitor for this. What they don't have and won't have, even if they join forces, is the unbeatable wealth of assets and entertainment that Disney has built or acquired over the years. In addition to its ever active film studio and distributor, Disney owns one of the three traditional terrestrial TV networks, a series of video streaming services that became profitable in 2024, and the leading sports broadcaster, not to mention the core of the superhero film franchise. So, faced with a struggling Warner Brothers Discovery, seeing Disney's substantially good numbers leads us to think that a buying opportunity could arise even from a medium To long-term perspective, because the stock had reached over $200, and now after this crash, which by the way was not too predictable from a charting perspective, since we had this support area that clearly coincided with the 200 period moving average, this dashed line, so the price had come back to this area, testing it 1, 2, 3, 4 times, and the 200 period moving average was also a coinciding support. So here the market bought based on price action, expecting a good quarterly report, which in the end we can't say wasn't good. But the revenue was slightly disappointing. Boom, crash, minus 7.75%. Now, in my opinion, we're at $105.80. I would try to wait for the $94 area to close this gap, which in this case I think becomes really interesting both from a swing perspective because we see resistance gap, but also from a portfolio perspective because in my view the stock has paid heavily like other stocks with good results after the quarterly report. So coming back here could be an interesting accumulation area. I always encourage you to take advantage of the forecaster terminal you see. How quickly and professionally, with an impactful and intuitive layout, it helps us. We have a 20% discount. The link is in the description. Take advantage of it. Happy trading to everyone. See you next time.